right, welcome everybody. Thank you for being patient with us. Today our topic is building wealth by investing in real estate. It's going to be Dan and I helping you out today, taking you through this presentation. And I guess the first question we have for you is, who here joining us today owns an investment property currently? Can you enter your answer into the chat box?
Yeah, that'd be cool.
2, 3, 4, 5.
Let's see.
Lean, awesome. Okay.
Yep, we have 3.
Yes.
Barb has one. Yep. Very cool. All right.
Okay. So I guess we have some first timers, right? As far as looking into investments, is the feeling I'm getting. Okay. All right. Well, let's move on and move forward and let's continue. Okay, Dan, what exactly is leverage? I feel like that's a really important definition or word that
Yeah, you know, as we started studying wealthy people who built wealth through real estate, we realized that they did a lot of it through leverage. So I wanted to talk really quickly about leverage. What is it, and why is it so good to use through real estate? Well, one way to look at it is if you had to buy, let's say you wanted to buy stock. Let's say you wanted to buy Costco stock. Right? Costco must be pretty good now. United Airlines, maybe not so good. But anyways, you bought stock, and let's say you wanted to buy $100,000 of stock. Well, how much do you have to pay them to buy that? Well, you got to pay them $100,000, right? But what if you bought a $100,000 piece of real estate? Well, actually, you could leverage that. You can leverage it by paying only 25%, but have the benefit of the 100% of the 100,000, right? So what if that 100,000 then grows to 200,000? Well, you only invested 25 into it. That's what's called leverage, right? And so we're going to talk a little bit about that. But I actually looked it up as a definition I think it's, I don't know, Google it. I can't Google it. Basically, it said leverage is an investment strategy of using borrowed money, right, somebody else's money, to increase the potential return of the investment. Basically, it's leverage is getting a loan, right? Simply put, how do you buy something without paying all of it? It's getting a loan, right? And leveraging your money. Well, with today's market being so, interest rates being so good, the leverage is outstandingly stronger than it ever has been. Meaning, you're going to be able to borrow that money at such a low cost of money. I think it's, what is it, John? Is it 3 1/4 now, roughly? This is John Davis. Let me introduce you real quick. He's with Oahu Home Loans, or Honolulu Home Loans. John, what is the interest rates now?
Yesterday, we were quoting 3.125 for single family buyers at 0.875 points.
Wow.
Okay, wow. What about investors?
For investors, it's 3.875 at 1.2. Rates bumped up a little.
That's unbelievably low, right? I mean, so you're borrowing money at such a low cost of the money, but you're gaining so much more by the use of that money over time, right? So it's one is the way we look at real estate investments, like this month, how much am I making, but also over the long term, how much am I making? And we're going to talk about that today, okay? The next topic we wanted to talk about is cap rate, right, Tiff?
Yes.
Right. Tiff and I, we have constant conversations about cap rate, and it's a simple formula, right? So it's a quick formula to determine the economic viability of any real estate asset. Really, it's so simple. All you take is your annual net operating income divided by the value of the property, or what you buy it at, or what you're going to sell it at, right? That's your purchase price. So how do you get your annual net operating income? It's pretty simple. You take your rental income, you subtract all your expenses for that month, gives you your monthly net operating income, multiply that by 12 to annualize it. That's how you get your annual net operating income, right? Pretty simple.
Yeah.
So the example we had, go ahead, Tiff.
No, I just wanted to say, yeah, cap rate it's kind of like a litmus test to just tell
Yeah.
you if that investment property warrants further analysis, right? So
Yeah.
just an initial test, yeah.
Yeah, that's our first shot at it to see, is this something really interesting to us? Is it worth being interesting, right? Because how is it performing, right?
Right.
And the example down below is, if you had $1 million asset, let's say it's a small apartment building or a house, and you had a $50,000 annual net operating income, then you're looking at about a 5% cap rate. Now, in Hawaii, 5% is kind of hard to get, almost unheard of, really, really difficult to get. In parts of the country, you can get 5, 6, 7% sometimes, but generally speaking, it's anywhere from 3 to 5 here in
Can I
Hawaii.
ask you a question, Dan?
I'm sorry?
Can I ask you a question?
Yeah, of course.
Why, and I think a lot of people probably are thinking the same thing, why is it so hard to get 5% cap rate here in Hawaii?
Yeah, because the cost of the property is so high relative to the income,
Okay.
right? The cost of the purchase price, the denominator is too high in many cases. Where if you go to Texas, we can buy some land in Texas and they built a 7-Eleven on it, and I can get a 7% cap rate,
Right.
Possibly. Though what happens if that's no longer there, you have 0, right? So there's risk return analysis to go through as well, but also it's understanding your risk tolerance, which is really important. Here in Hawaii, we're really sound. We're really a sound long-term investment, and we're going to talk more about appreciation in a minute.
Sure.
Well, let's go through some examples, Tiff.
Yeah.
So we got 2 examples, right, Tiff?
Yeah.
Tiff put this great project together. Go ahead.
Sure, thank you. Yeah, so like Dan said, we have 2 examples to show you. So what we look at when we're helping investors, this is what we call an MLS, and this is what we see, all the information. So we highlighted here the very important details. The price, of course, $288,000. In the description, you see that the tenant pays $1,800 per month. So off the bat, you're like, wow, $288,000, $1,800 a month. That sounds really good.
Sounds good.
Right? Yeah, and it's in town. It's
Right.
in Punaho. It's a 211. It's actually rather large, 690 square feet, interior space. And what else? Yeah, built in 1960. But then you look over here, go to the right, Dan, and circle the maintenance fee. The maintenance fee is rather high, and it only covers your sewer water. No problem.
Right here.
Yeah. So makes us curious to want to know more, right? So this is what we do, is to figure out the cap rate. As Dan mentioned before, your cap rate is just taking your net operating income and dividing it by your purchase price. So our total income at the top there annually is going to be $21,600. And then we took all of our expenses below and annualized it. So property tax, general excise tax, your insurance, property management, with which most people will probably go for, which is 10%. Then you have your maintenance fee, and then just a placeholder for repairs in case you have to address any issues with the property. So that brings your total expense to $16,000. By the end of the year, your net operating income is $5,000, close to $5,200. And you just take that, divide it by your purchase price of $288, and that comes up with a cap rate of 1.8%.
So when we look at a property like this, initially, let me go back, like Tiff was saying, wow, under $300,000 for a 2-bedroom, that sounds like a pretty nice deal, right?
Yeah.
Until you look a little deeper, the impact of these maintenance fees is significant. Look at the cost here.
Right.
It's $10,000 a year just on sewer water and maintenance fees, right? That's why this number is so low. Right? If this was half of that, it would greatly increase. But the biggest expense, as you can see, right here.
Yeah.
Right. Right there. All right.
Yeah.
Let's take another example.
Okay. Here's the next example. Now this one is a property in Eva. It's a little bit more at $345,000. However, it is a 3-bedroom, 1.5 bath with 1 parking, and it's rather large. It's 1,300 square feet. Now my favorite part, if you look over to the right there, and it's even highlighted in the public remarks, that it has a low HOA of 303. It covers other common expenses. And it's also newly renovated, which tells me the upkeep and maintenance of the property is probably, you're not going to have to be dealing with too many repairs, at least for the next 3 to 5 years. Okay, so let's take a look at the cap rate for this, Dan. So same thing, right? We're taking our total income. And now for this one, we didn't know what the rental income was because it's vacant. So what we had to do is just come up with rental comps, which is similar to how we find comps when we're pricing out properties. So we came up with comps of similar properties so you can get about $2,300 per month for this property. You minus out all of your.
I'm sorry, sorry to interrupt. Just for people's clarity, comp is a comparable value of rental income. So what Tiffany did is we have a way to look at the properties that are rented and what they rented for. So this is data from people who actually rented them, not hoping to rent them. These are people who actually rented them and got an agreement for 12 months of a property similar to this property. And that's why we got to the 23, yeah?
Yes, thank you. That's really important to explain. Thank you. Sometimes I forget because I do this so much.
I know, right?
Same process, right? Then you minus out all of your expenses. So if you end up with a net operating income of $16,900, and you divide that by your purchase price of $345, and look at your cap rate, 4.9%, which, as Dan alluded to earlier, is pretty rare to find anything close to 5% here in Hawaii. So I think this is important to look at. Those are the two properties we just looked at in comparison, and we just took the meat of the information. What would be really important is the difference in neighborhoods, the difference obviously in price point, and the difference in income, the difference in expenses, and the difference in the cap rate. And Dan, why don't you explain what the importance of this is showing? I mean, we don't want to say that town is necessarily a bad place, but it's not, take away the neighborhood. Really what impacts these numbers here at the end is income and expenses, right? So these numbers really drive this number, right? Because look at the income is 21,000, but your expenses is 16,000. Whereas your income was 27,000, you only have a $10,000 of expenses. So you got $6,000 less of expenses, yet you got $6,000 more of income. That's $12,000 difference, right? Yes.
And so that's why your NOI is going to be so much greater here. And even though the price is higher by, what is that, $67,000 more money to invest in, your cap rate is much higher, meaning the asset is producing at a higher rate than the previous one. So what we do is this is exactly the same analysis we do with all of our clients is we do a asset performance test. We take a look at their asset, we measure it on a cap rate basis, and then also a cash flow basis. Then we measure that based on the sale of that home. Let's say it's $300,000 or $100 or $1 million, whatever it is, and we find another property that has a better return or a cap rate. Then we can say that, if you sold this and bought this and spent no more money and you increased your cap rate, therefore increased your cash flow, is that something you'd be interested in? And obviously everybody says yes, right? I mean, who wouldn't be? And if you have an investment property and you're curious, then just, text Tiff at the end. There'll be a chance for you to text that, so yeah. All right.
Okay, so cash flow. So it's a deeper dive into determining if this property is going to be viable for you on a monthly basis. So just taking the example of the first property, at the top here, that's it gives you your cap rate, right? Then what we're going to do now, talk about leverage. Most people are going to leverage the low cost of money to get a loan, and so cash flow includes your mortgage payments, okay? So you take, for this example, if you had to do a minimum of 25% down, okay, just by simply inputting loan terms into a mortgage calculator, I know that on an annual basis, your principal and interest payments will be about $12,000. So you take your your what is that, your income for the year. Yep, $5,197, and you minus your principal and interest payments, and that's going to show you a negative cash flow, meaning every year this property is going to cost you out of pocket $6,991.
And let me just make a comment on that. So initially, when you look at that, that's not a good thing, and yeah, that's not an area that I would definitely focus on. Though there are some people who are actually investing, and even if it's a negative, like a small amount, like we did when we bought our first investment property, we were negative about, what was it, a couple $100 a month. It wasn't that big of a deal because it was a tax write-off. It was a strategy, right? But that asset grew, and then we did a 1031 exchange. We took the equity out of that, bought another one, right? That asset grew.
Yes.
And so we weren't really so concerned about cash flow initially getting into it. We were really looking at capital appreciation, right?
Yeah.
Which was a smart thing to do because it allowed us to parlay that over the years to bigger and bigger assets.
Right. Yeah, I agree. I think it's a bigger picture. These are just very broken down segments of how you analyze the property, but per each person's situation and goal, right? Just like what you explained in yours is, it's going to be the bigger picture. But this just shows the cash flow.
But this is something that we'll do for all of our clients. We before somebody buys a property, we want to make sure that we've done our due diligence, and we've been doing this long enough to, we've got a lot more spreadsheets, but we're just trying to keep it simple. There's a lot more analysis behind this. We just had to keep this simple. So let's look at example number 2.
Right. So example number 2, very different, right? We have the high cap rate of 4.9%. Again, using the same loan terms and doing minimal 25% down for an investor. Look at your cash flow after you pay out your principal and interest by the end of the year. You're positive $2,300 every year on that property. And basically, if you, I know we didn't really touch upon it in the last slide, but cash on cash return, the box below, that's basically telling you that on your cash investment, now remember, you're only putting 25% down. So the cash you're putting into this property is $86,000 at the bottom. Yeah, right there, Dan, thank you. Plus your closing costs and then your loan points. So you're putting in almost $100,000, but you're getting a return of 2.38% on that $100,000. So talk about leveraging your money. If you had your $100,000 sitting in the bank, you probably wouldn't even get 1% interest on that.
Well, here's another thing to think about too. What if you have equity in your home and it's just sitting there, but you're not gaining anything out of it?
Sure. Exactly.
What if you took $100,000 out of equity out of your house, and now every year you've got a good cash on cash return. You got $2,000 more than you had the previous year.
Exactly.
Right.
Yeah.
Without really doing anything.
Right.
Yeah. And the cool thing is as you increase your down payment, look at your cash flow.
Yes.
Right. Look at what could happen over time, and that's just every month, every year, right?
Mm-hmm.
The other question is, where is your money at today, and what is this cash on cash return, right? And that's where you can start looking at different opportunities for moving some money around. Right? There are a lot of people now that aren't real comfortable with where it's at, so they're considering real estate. And if you are, we'll just do the simple analysis, right, for you.
Yeah.
Cool. Let's talk about appreciation.
Okay.
Yeah. So, nationally, on average, around the country, they're looking at 3 to 5% appreciation, right, over the years. Let's take a look at our data here in Hawaii. Okay. So from 1987 all the way up to now, right? That was a long time. What's that? 37 years? 57 years? No, can't be. I'm 57. 37 years. So if you bought something in 1987 and sold it in 1990, you had a huge appreciation, right? You went from 160,000 to almost 300,000, almost doubling your money. What happened after the peak? Took a bit of a slide, right? And this dip here, this recession, it took 12 years to get back to the same values as it was at the peak, right? Well, what happened when you held on to the property, right? If you can hold on to real estate, it doesn't matter, does it? Because it's going to go up again, right? So imagine buying it here, and now look at you owning it here or anywhere over here. What happened to that asset? Well, it's going to grow. In fact, let's take a look at a closer view. We just took the last 20 years. Okay, we said we were going through this together prior to getting ready for this class, and we said over the last 20 years, you know, what has it been? And it's been 5% appreciation, even with the downturn here. Even with this downturn, it was a 5% appreciation for the last 20 years, year over year. Okay, is investing a good place to put it to build wealth? Well, I don't know where you're going to get 5% a year, other than real estate, honestly. You might get lucky in the stock market, or maybe not. There are some people on the not side right now, apparently, that aren't so happy, but we won't talk about that. The other item to talk about is depreciation. So that's another thing. So we talked about appreciation. We talked about leverage. Now we're going to talk about depreciation. Now, I'm not a CPA, and you're going to talk to your CPA. You're going to talk to your accountant. That's something that we want you to do. But what we do know is that you can depreciate your investment properties or any part of your home that you're only using exclusively for business, meaning there's a door on it. You can close it off, like my office. This is my home. I can depreciate this room because I only use it for business, right? I don't mix and match my environment, right? It'll allow you to lower your overall tax liability. And so that's how people build wealth too, right? The less taxes you spend on and pay for, the more money you have to invest in, right? And when you're depreciating, remember, you're only depreciating the structure, the house. You cannot depreciate land. Land does not depreciate. Land appreciates. Homes depreciate in the eyes of the IRS, right? And then the way they calculate that is the IRS says, well, you take your asset of the building, the value of the building, divided by 27.5 years, because that's the life expectancy of that home from the eyes of the IRS, right? And then you get a number, and that's your depreciation expense. Right? This is what we're told from CPAs. Please talk to your accountant and CPA to make sure you understand the benefit of depreciation. We just wanted to touch on it very briefly because that's something that a lot of people don't really consider when they're building wealth, right? Anytime you can reduce your costs, as you saw in the cap rate and the cash flow, reducing costs or getting lower costs is like reducing your taxes, right? That's the cost. So keep in mind that depreciating investment properties is another valuable way to look at that investment property.
Absolutely.
And then you can also depreciate capital improvement. If you put an ADU in the back that you're using for your office, or you're adding another bathroom in your investment property, that type of thing. That all can be depreciated as well. Okay, creating a legacy. You know, over the past probably 10, 15 years, we've had, because we do a lot of work with seniors and older adults, helping them transition life, they also are the same population that have investment properties, right? So what we've done is we have created a way to make it easy for people to create a legacy with their real estate, right? In the chat box, do me a favor, put yes or no if you've ever heard of a family who fought over real estate after mom and dad died. Do me a favor, put it in the chat, yes or no. Have you heard of a family who fought over real estate after mom and dad died? Yes, yes, yes. Yeah, almost everybody would probably say yes. Yeah, all the time. Oh, yes. Yeah, why is that, right? And we have a whole separate class of that, but what we're going to talk about today about building wealth and creating a legacy, this last portion, is a solution to a potential problem. So one thought is, the scenario we're going to draw out here, we're going to take you on a journey is, mom and dad had an investment property, let's just call it an apartment building for now. They had some investment property, and they've got 4 kids, right? And mom's a widow, and she doesn't really want to deal with it, but it just generates money for her to spend and take care of the kids and grandkids, right? But nobody really talks about it, and nobody really plans around it. It's just, it is what it is. This is something that dad bought. Mom inherited because dad passed away, and now it's cash flow, and again, we don't really talk about it, right? But she's heard of her families, her sisters, and her cousins that when they're passed away, their nieces and nephews fought over real estate, right? And she said, wow, you know, I don't know if I want that to happen. Is there a better way? And the answer is there could be. There could be. Because imagine this, everything is great, you know, over the holidays, you know, everyone's getting together, back when prior to COVID, right? Halloween, Thanksgiving, Christmas, everything's fine, right? Everyone loves on each other. And then mom and dad die, and then one of them becomes a successor trustee, right? And then they have to sell it. Well, what if, in this case, Grant's the oldest, and he's the successor trustee, and the trust says to sell it and split the proceeds? Well, he's got to do his job and fulfill the wishes of the trust, which is mom and dad's wishes. Well, what if Lucy says to him at that point, you know, I'm kind of emotionally attached to it. I don't know if now's the right time. So Lucy's going to put pressure on Grant not to sell it, right? George says, no, hey, the trust says sell it. I want my share because I want to do something with that money. I want my share, so I need you to sell it. Anne's like, well, I don't know if this is the right time now. What happens now? Well, then Grant's in a tough position. The successor trustee, he's supposed to fulfill the wishes of the trust by mom and dad, but yet his family, his brothers and sisters are not in alignment. That's part of the problem. So mom says she's seen enough of this. She says, let's create a solution before this problem arises. So mom has come to one of our classes or spoke to an attorney or a trustee or a financial planner, somebody that has said, hey, I talked to these guys, they have a plan. Right? And here's one opportunity. Mom says, I sell this large asset, whatever the asset is, big or small, and I buy 4 of them. I do a 1031 exchange while I'm alive. I'm alive now, and I'm going to sell the large asset, and I'm going to buy 4. And the reason for that is I'm going to put one in each of these kids' names in my trust. I'm going to own it all, but I'm going to allow them to predetermine their inheritance. Predetermine their inheritance. So let's just say for round numbers, this is $1 million asset, right? And she says, I'm going to sell that $1 million asset because, frankly, I don't want to deal with it, and we've hit the top of the market. Right? We've hit the top of the market, and I want to sell it, and I want to get the money to my kids and my grandkids, or at least have the right to use it, right? The right to use it. Because that asset would be sold, and then she buys 4 of them, of which all stay in her name. It does not get passed to the kids yet because it's in her trust. And you want to keep it in your trust because that's where it's safe, protected from capital gains. Because when mom passes away, the kids get these assets that they predetermined. They were part of the selection process with mom to buy them. Why does this plan work so well today? It's because most of these families are not living in the same house anymore, nor are they living in the same community. Half the time, they're not even living on the same island, right? They're living somewhere else. Where do you think they want their inheritance? Well, they want their inheritance near them for their kids, for their next generation. For the benefit of the future, mom is now creating this opportunity that allows the 4 kids to be part of their selection process of their inheritance. Here's a cool thing. In this case, George, you know, he works in Seattle, and he has a house out of the city, but he wanted it would be cool if he could have a place in the city. So mom says, you know what, I don't need that asset. I'll sell, and I'll let you select your replacement property, and it can be in Seattle in the city. And by the way, I don't need the income, so you can stay there if you want, but it's going to stay in mom's name until she dies. Okay. Lucy, on the other hand, she never bought a house before. You know, she raised 3 kids by herself. She's working paycheck to paycheck. Mom now says $250,000 is yours to select a home that I'll let you live in, but I'm going to own it until I die. So now Lucy puts $250,000. Mom puts $250,000 down in a house. Lucy gets the mortgage for $200,000. Now they're co-owners of an asset that's partly owned by the trust, partly owned by Lucy. When Mom passes away, it goes straight to Lucy tax-free because she gets the stepped-up cost basis of the asset that she's selling from Mom. She gets to pass it on to Lucy at a stepped-up cost basis, which is tax-free, right? Same thing with Grant and Ann. So these scenarios are taking place all the time now around the country. And we're teaching this class all around the country to real estate agents to share this strategy or potential strategy for families who are trying to create a legacy. It's not for the inexperienced to do. 1031 exchanges are tricky, but if you know how to do them, that's the way to do it.
And I think
Any questions on? Yeah.
Ultimately, the families stay happy, right? Preventing the disputes and the headache of trying to decide what to do with that one asset.
Yeah, yeah. And you know what's hard is as families gain wealth and they buy and they accumulate more real estate, the problems get bigger and bigger, right? And so while that's a good thing, that can be a downfall of a family, right? It could be a separation of the family. And our goal, like Tiffany says, is how do we keep the family together? And how do we get them to rally around what Mom and Dad had done over the years to accumulate wealth? And how do we create generational wealth together as a family with a plan, with a steward, and with a strategy? And at the end, you'll understand how to create strategies as we go through this. But as we start moving on, we pulled this out because you know this guy on the right, right? He's pretty wealthy, I guess. Some might say. Yeah. And what did he say? Never depend on a single income.
Right.
Make an investment to create a second source. In one of the wealth building classes we've taken is they say what your goal should be to have 5 streams of income. And if your income that is passive income can equate your active income, you can retire. That's the goal, right? So how do we build wealth such that it'll create passive income so that we can retire and stop the active income because the passive income got so big that you can retire on it. That's the goal. Right? And so why are the wealthy investing? Well, obviously appreciation, because that's how you take an asset and it grows. You can sell it and buy something else and grow and sell it and you keep appreciating and growing wealth. Cash flow every month, right? Every month getting a little bit more money that's passive. You know, when I ask people, you know, if this asset grew, you know, $50,000, right? Whatever it is, how long would it take you to save $50,000? And everyone kind of laughs. We don't save money, do we? Right? Although real estate, it kind of does it for us. You see, that's the leverage part. The leverage part is real estate actually is our saving plan when we're really not saving, right? We invested it one time, it's building wealth, it has cash flow, has future appreciation, it builds your equity, and it reduces your taxes, right? There's tax benefits in there. And then for those who are thinking longer term, it's really about legacy, right? How do we help out our family? You know, a lot of families now are saying to me, Dad, I don't know how this next generation is going to buy homes. And my answer to them is, you're right. I don't know how they're going to buy a home if they don't have a plan, right? If their families don't have a plan. Because frankly speaking, the next millennials, they spend more money than they've earned. I know, I got kids. I shouldn't say that, I shouldn't laugh. It's pretty bad. But really, yeah, they're going to need to rely on their family, honestly. As values will grow up over time, right? It's going to be hard to live here on this island. Like, whoever thought we'd have $600,000-$700,000 median sale prices, right? Tiff?
Right. Yeah. Absolutely. Even condos too, right? Getting upwards to closer to $500,000.
Right.
It's incredible. Yeah. So Dan,
Yeah.
just kind of going through all of this and why the wealthy invest in real estate. If someone were curious in doing this, what would be the next steps? What do they do?
Well, yeah, real simple. They can sit down and create on their own a 5-step strategy. So real simply, there's only 5 steps for you to do this. Number one, understand your situation. And most people say, well, how would I already know my situation. Well, we're going to sit down and really ask questions to bring clarity to that. Because your situation may not be clear at the moment in different perspectives. Regarding your family, regarding your future, your current situation. What do you want the next 5, 10, 15 years to look like? And how do we get there, right? How do we create that? And so what we first is identify what are our challenges, like what's going to prevent us from being successful in the area we want to be successful in. And then identify, okay, what's really the goal, right? What's my goal? And then now let's create some plan or maybe some options of how to get to the goal. Whether it be your primary residence, or if you're a first-time buyer, or you want to upsize, or you want to downsize, or you're thinking of building wealth and creating a legacy. Whatever that is, we really want to sit down and talk you through maybe different options. You know, we've seen thousands and thousands of different ways that people build wealth. And from our experiences and the conversations we've had, we can then sit down and create a plan, and maybe you're going to timetable for you. And then lastly, just put your team together, your professional team. You know, anytime I talk to a seller, when people call me to say, hey, Dan, I want to sell my house, I ask them 3 questions. First question is who's your CPA? Right? Who's your accountant? Because when you're selling a home, you want to know what your tax liability is. When you're buying a home, you kind of want to know what your tax benefits are, right? Because a lot of us don't consider our tax benefits in that. The other is an attorney, trust attorney. Like when you buy real estate, you want to put it in a trust because the trust is going to keep it safe from probate in the event that you pass away, right? Things like that. But also, as you start building wealth, you want your trust to be your instruction manual for how you want your assets to be distributed, to handle, managed. That's all going to be in your trust. There you go. And then your financial planner. You want to have a really good plan. If you don't have one, please reach out to us. We'll give you some names and numbers. You want to have a good financial planner that's going to plan for your stage of life. For example, we have clients that are older, 70s, 80s, 90s, that they don't need risky things. What they need is preservation, right? They need to make sure that somebody's there planning their wealth and also kind of giving them a confidence level that they're not going to run out of money. Or give them clarity to, if they are going to run out of money, how long that's going to last. And what do you do after that, right? Like, how do you plan for Medicaid, that kind of thing. But when you're buying, you really want to understand your expenses and understand your cash flow as well as all the other financial resources that you have. You want somebody to steward that. You want somebody to take a look at your net worth sheet. That's a good question. Does everybody have a net worth sheet? Right? If you have a net worth sheet, what that is it shows you all of your assets on one sheet of paper, right? From your stocks to your bonds to your retirement to real estate. And you want somebody to give you a holistic approach view on where you are and where you want to go, right? And so we'll help you put your professional team together. Building wealth, no one succeeds alone. You're not going to do this by yourself. Even the smartest guys have a team. Warren Buffett has a team, people, right? So we all need a team.
Yeah.
And then the last question is, who's helping you manage your real estate, right? Do you have somebody helping you create a strategy for building wealth in real estate? Well, if you don't, I know somebody that might be able to help you with that. Yeah,
yeah, I think ultimately, ultimately, this is your journey, right? This is your goal, and that's what we're here to do, is to help you succeed and figure out your plan for the rest of your life, right? So this has been a lot of information, don't you think, Dan? I mean, a lot of number crunching. You know, it's not for the faint of heart, especially if you're new to
Yes.
this. And so, you know, absolutely, if you have questions or want to have us go over a plan and strategy with you, please give us a call. You can text me. My number is right here on the screen. And it's a free, private, no obligation strategy session for you. Yeah, tailored to you. Does anyone have questions? By the
Yeah.
way, we went over a lot today.
Any questions?
Any of the topics? Thank you,
Thanks,
Barbara.
Barb. Yeah. If anybody wants to buy anything on Maui or sell anything on Maui, that's the couple to help with. Epoxy, they're awesome on Maui.
All right.
Yeah.
Hey guys, you know, I do have a question. You know,
Sure.
we have some savvy investors, people that bought and sold, and maybe some people that are looking at buying their first one. You spoke about a gap between where you are and where you want to go. Having that first conversation kind of could be a little bit filled with anxiety, right? Because it's like I don't want to hear any bad news, or so that first step is kind of a struggle. What do you, and even with JD, what advice or what encouragement could you give somebody to have that first conversation?
I think, you know, I've been blessed because my mentor is Gary Keller. He's the founder of Keller Williams. And what Gary's taught us to do is to dream and to bring clarity to what your vision is. You know, he basically says to us, if you don't have a goal of where you're going, how you plan on getting there, right? And that's kind of really true. If you think about traveling across the country, if I said to you, let's go to Washington, D.C. from California, and I just tell you, go. You don't have a plan, it's going to take you forever to get there. Or you have a plan and you have a GPS and a plan to get there, it's so much easier, right? You know what the next steps are. Well, that's kind of what we do. We sit down and just kind of help people dream, kind of uncover some things that maybe are in their mind, but they're thinking maybe not, but maybe so. And that's the best part about our conversations and our strategy sessions is it's fun, right? We get to dream and we get to think big and say, what if we could do this? I had never dreamed of having life we have. What if? You know, what if you could have an investment property that took care of a portion of your kid's college education? What if? Right? We have a lot of clients that are doing that today, that are saying, you know what, kids are getting older, colleges are getting expensive. How do we fund it, right? Or how do we fund retirement, right? Yeah. Or how do we plan for my kids who are going to get married soon? We had one client that had some investment properties, did very well, and were able to bless their kids with a home, right? That would be a dream come true for everybody. For the kids too, right? I never got a home, but hey, that's okay. Yes.
Hey, Dan, while we have John here, maybe John can go over some ideas, leverage using some lending tools.
Oh,
John, you want to speak about that?
going back to leverage. Yeah, Dan, I had a friend who bought a rental condo in the Punch Bowl area, and their plan is to have a condo for their daughter when she's 2 years old. Yeah, but basically bought her a condo for 18 years down the line. Get her out of the house.
Well, we know, but we know what happens over 18 years, right? You know, that's going to appreciate it.
Yeah, he's a smart guy. So yeah, there are different tools. I appreciate the information you shared, especially on the leverage part and how the financial side affects your cash flow. Different tools available: home equity lines, cash out refinances.
Yeah.
And these are effective and powerful tools. So for example, the home equity line, you're able to mobilize your equity or capital a little quicker than you would on financing. You can go into a transaction or make an offer with basically cash. Yeah. And these are equity.
So can we talk? I got a question for you. So home equity line of credit, HELOC is what we call them, right? If people have ever heard of HELOC, that's a home equity line of credit. In fact, I just had this conversation yesterday with one of our clients. he's going to be calling you actually. But he wants to buy a home. He's in a home today. We helped him buy a condo. He sold the condo, he bought a house. Now he's going to sell the house to buy another house closer to town, right? But he says, well, how do I do that? How do I buy when I got to sell? So one option is pulling equity out of his house, which he's got $250,000 at least. And he's going to take that equity and just put it as a down payment, right? To buy that house, as long as he's got a mortgage, be able to get the mortgage on it, then he'll sell his house, move in, right? The low cost of the money is really why the leverage is so strong today, right?
And we're noticing that across the country, some of the bigger lenders, your JP Morgans, your Chase Banks, those guys are ending their home equity programs. In Hawaii, we're lucky. The banks are, I think it's the season right now, they're rolling out promotional rates. We are able to offer a fixed 1.75 interest only payment for 2 years. And that's for a line up to $250,000. We go to 80% loan to value. So, you know, if you have equity in your property, you could, you know, mobilize it pretty quickly if you see something you like.
Wow, that's terrific.
Yeah, Helena,
is there a appraisal fee on that?
No, that's a bank valuation. Yeah, again, it's up to, and the beauty of the equity line is that they close relatively quickly if you don't have an existing one. If we're just adding one to the title, basically, it's a relatively quick process within a couple of weeks. Yeah.
Wow.
So that's a good.
So Helene had a question. Can you use a home equity to purchase a rental?
Yes, absolutely. It's your money. Yeah.
Right. And did the law change so that you can only use the equity in a loan to repair or renovate your loan?
I think what Helene is referring to is the cash out refinance. Yeah, that's a fixed loan. That's a 30-year loan as opposed to an equity line. The terms are generally shorter, 20 years. And there are state purposes for the cash out refinance. Yeah.
Yeah, this is more of a short-term plan. So if you're selling a house and buying one, it's a way to get down payment money at a very low cost for a very short term, right? To be able to buy something and then sell your house to pay off the loan.
Right.
Yeah. Or if you wanted to renovate, right? Or if you wanted to buy an investment property, a lot of different options. Cool.
Great questions, Helene. Thank you.
Yeah, thanks. Yeah, bring on the questions. Keep on coming. As we close up here,
Wait, can I ask another question? So, John, when would you recommend a home equity versus a cash out refinance?
It depends. Again, it's worth having a talk. There are pros and cons to both. It may be a little easier to qualify for a cash out because of the way the payments are calculated, for example. Your payments will also be relatively the same on a cash out. For just a small margin above, you get a lot more equity out of it, yeah? Whereas on an equity line, you're adding to your existing mortgage payment, yeah? And of course, as Dad mentioned, you've got to have the strategy, right? So what are you going to do at 2 years when the rate bumps up to, well, it's only 4.5, but still, you have a plan, always.
Okay.
Yeah.
Thank you.
Yeah. Thanks so much. Any other lending questions? This is a good conversation. Is it hard to get a loan today, John?
No, I think that the way the process is now, it's not very fun. I'll go ahead and say that, but they've got it down to a science, and it's not hard at all. If you're well qualified, it's a breeze.
Okay, good. It's not like I gotta dig out my teeth or something. It's not like I'm pulling teeth, right?
I hope not.
I'm just joking. No, it's fairly painless, right? I mean, you got to provide information.
Right. It is a process. There's a mountain of paperwork, but that's why you've got behind every good loan officer is a team of nerds, basically, that crunch the
We like nerds. What are you talking about?
Yeah, and since we had some of those questions and it's really like a personal, specific, situational thing, John, I mean, how do people get in touch with you again?
Oh, could you put it in the chat? Then people got your phone number.
Oh, thanks, Carrie. Yeah, I'll put that right in the chat. And of course, I think their links through the Zoom meeting are there to reach out to the team. And, we work together almost on a daily basis. So reach out to them and you're pretty much in touch with me.
Yeah.
Let me
Cool.
add it.
Cool.
Thanks.
Thanks, John. So what are all these logos? Well, the R team, again, we started 15 years ago. We have a very large team now. I think there's 28 of us, 28, 29 of us. We started this thing called the Complete Solution, which is trademarked for the United States, because this is our coaching company as well. We have a property management firm for those who are buying investment properties, where we can manage those properties at a really high level. We have one of the top rated systems for property management in the country, and we're using that now. We have Stage Hawaii, which is a staging company where we make properties look good. Tiffany actually runs our staging company. I suggest that you take a look at our listings because you'll see how beautiful they are, and mainly because of Stage Hawaii. Senior Move Managers, we started 10 years ago helping older adults downsize, declutter, and move. We're topping closer to 800 families that we've helped now. Downsize, declutter, and move, and then Declutter Hawaii for those who are not moving. And then Silver Spoons is our nonprofit designed to take care of older adults who cannot take care of themselves. And we take some of the profits from these organizations to put it in to fund those who are in need. We actually have just one more week in May. Gosh, can you believe that, guys? We're done with May.
Half the year's gone.
It was an interesting journey because we've been doing seminars since 2005, and we've done over 1,000 of them, and then we can't do them, so we started doing these webinars. And my apologies of not being able to hear me well or if I mumble. Yeah, anyway, we're relatively new at this, but we'll have a great support team. Next week we have Building Wealth through a 1031 exchange. So if you own investment property and you're thinking about the 1031 exchange, you want to come into this class. This is lunchtime Thursday, next Thursday lunch. And then we have another one, Knowing Your Rights, on Saturday. If you are thinking of buying, you do not want to miss this class. This is where the rubber meets the pavement on buying and knowing what your rights are and how to protect yourself. And then in June, we have a whole other series of them. Trust Sales, I'm a trustee now what? This was designed for older adults or really trustees who became successor trustees after their parents or uncles and aunties passed away. And this is a culmination of 10 years of people asking us questions. What do I do? And so that is an amazing class. If you know of anybody who's going to be a successor trustee or is in a family situation, yeah, you'll want them to come and check that out. Is now the time to buy? That's on the 6th. Senior Living Options is a class that we've been doing a very long time. But if you know anybody who's getting older and their home's not quite fitting their needs and trying to figure out where to go, aunties and uncles, family, friends, yeah, have them come and check this out. This has been a widely received class. And then on the 13th, we're Building Wealth through Investing in Real Estate again here. All right. In closing up, this is our team, our buyer agents, and our mission really is to honor God by serving others with the highest level of competency, care, and compassion with uncompromising integrity. Wrapping up, you want to take this one, Sis?
Yes. So let's see. Sign up for a free strategy session. You can use a chat box, or if you took down my number from the previous slide, you can text me as well. Then feedback, as usual. We're all about growing and getting better. So feedback is definitely appreciated. You can go to this link here. Are we putting the links into the chat? Oh, thank you, Carrie. He's got it on it. All right. Okay. And then also for our upcoming webinars, which we posted previously, you can also check them out at iharateamhawaii.kw.com. I believe Carrie will probably post that link in.
Hey, you know what? Breaking news.
Yes,
Breaking
what?
news from everybody. Let's update that thing here. So I'm going to put in the chat. You can go, and it looked like it copied and pasted. So you can go to iharateamhawaii.kw.com webinar schedule for our schedule of upcoming webinars, and we'll have June up there very shortly. And for anybody that wanted to review and rewatch this recorded webinar and ones that we have done previously, there is now a page for recorded webinars. I just put that link in the chat as well. And so we'll have this one uploaded, but we have a couple of the ones that we did previously up online. And of course, we are on Facebook Live, so you can always follow us and see those recordings and share those with any interested family or friends through Facebook as well.
Nice. Awesome.
Thanks, Carrie.
Thanks,
That
guys.
is good news. And then last but not least, we still are doing open houses, but virtually. So every Sunday we host, a few of our listings via virtual open house, and that is the link there, iharateamhawaii.kw.com/virtual_walkthrough, where an agent or a team member will actually be in the property live, taking you through, answering your questions, and telling you about the property as if you were there with them. That's it.
Yeah, that's pretty cool. Thanks, everybody. Any last questions before we clock out here today? We made our time frame, Jeff. We did okay on time. That's how we're
Nice.
gonna run out.
Oh, great.
Yeah.
Yeah, we did. Perfect.
Well, it's a beautiful day out there. Enjoy yourself. Please let us know what you thought. Give us some feedback. And then also, if you wanted to get together, talk about your strategy, send us a chat or a text or an email or call. We'd love to sit down and discuss your personal strategy. It's one of the blessings that we have in our life where we get to join the journey of people's life as they grow. And 15 years of doing this, I've seen a lot of families grow and build wealth, and it's what we look for. So thanks, everybody.
Thank you so
Thanks,
much.
Martin.
Have a great day.
Okay,
Thanks,
have
Kurt.
a great day. Great
Take
Memorial
care.
Day weekend.
See you guys.
Bye.
Yes.
Woohoo.
Take care. Bye-bye.